following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tosaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and that rockin' tune means it's time once again for the Option Block. This is, of course, your bi-weekly source for all things options related. A little bit of wit, a little bit of wisdom, a little bit of analysis, a little bit of perhaps speculation, a little bit of strategy and education, and of course a sprinkle, a cherry indeed on top of entertainment. My name is Mark Longo from the optionsinsider.com, as well as the old Options Insider Radio Network. And joining me on the old all-star panel today is one rock lobster dialing in all the way from Maine. He is Andrew Giovinazzi of OptionPit.com. Mr. Rock Lobster, how fare things in the great state of Maine, sir?
A little rainy. No lobsters jumping in the boat, although we are going to go grab some clams this weekend. But life is good. Life is good. Trading is marginally interesting, but that life is pretty good.
You sound like Tosaw. Every meal is a feast. Every day is a fantastic celebration of all things life. Speaking of Tosaw, he'll be joining us a little bit later. But in the interim, we are joined by yet another newcomer to the program, holding down his first tilt at the old Options Express hot seat. He is Dave Vitamonis, a trading specialist over there at OX. Dave, welcome to the program.
Yes, hello. Nice to be with you.
Now, Dave,
and all of you.
Dave, why don't we do this since this is your first time on the old show? Why don't we take a couple of minutes, give our listeners a little bit of an overview of your background in the options business and kind of how you got to where you are at OX and what you do there on a daily basis.
Well, we're on the trading desk, and I guess we would be considered a senior broker. Started out on the floor at the Board of Trade and worked for a few companies up, and I've been with Options Express, about almost 3 years now. And, of course, I've traded options, probably since the early to mid-'90s. I was trying as a youngster. But hopefully my skills have been honed in all those years.
Were you on the CBO or the CME or the Board of Trade? Where did you trade?
I was in bonds and Note Pit.
Mm-hmm. We won't hold that against you.
Thank you. Appreciate
Most of us are degenerate former equity options market makers, but we won't hold your brief dalliance in the Note Pit against you.
I understand, but that's my passion. I do love the options, even back then.
And, of course, we will be joined a little bit later by good old Uncle Mike himself, beaming in all the way from St. Charles, Illinois, a little bit closer than Maine, Andrew. So he has no excuse. But with that, we're going to dive right into the trading block.
The trading block.
All right, and welcome to the Trading Block. This is, of course, where we talk about what was trading, what was moving the old markets. And we actually had, despite what Andrew said earlier, we actually had a little bit of activity today. And, of course, leave it to the day when I'm mostly out of the office at some big conferences in town that there actually is some activity in the market, so to speak. We saw the S&Ps closing up almost a full point, about 0.7 of a point here to close at 1461. The Dow up about roughly half a percentage point to 13,575. Good old NASDAQ. The laggard today, which is unusual. Usually it's been leading the charge of late. Today only up about half a percentage point as well to 3149. The good old VIX cash, not surprisingly, closing to the downside today, down nearly a full point to 14.55. So let's start there, as we are wont to do. Andrew, anything interesting, anything exciting, anything blowing up your skirts in VIX land today?
Oh, just, yeah, you know what? I think everybody's starting to handicap the non-farm payroll a little bit. You're feeling all the good vibrations. So they marked the volatility. Actually, it actually looks much like the volatility action the week of the non-farm payrolls. No surprise, last month. So they bid up the volatility at the beginning of the week, and it has slowly petered out. The market's, rallied a little bit. News might not be so bad, or maybe just at the ADP report. It hasn't been super accurate lately, so... But I thought that was I was surprised that they actually took it down as much as they did before the number.
It is interesting, because we talked about it quite a bit on our previous show about how we thought people would primarily be keeping their powder dry going into non-farms, of course, the second to last non-farms before the big voting day. But
they sold it.
Yeah, exactly. They sold it. And of course, there has been a little more information, like you referenced, since the last time we talked. ADP and some other numbers have given us, I suppose you can say, a little bit of perhaps insight into what we might be expecting for non-farms. But you're right, that hasn't been particularly accurate of late. So I was also a little bit surprised that people were so willing. Of course, I don't know why I'm surprised anymore. I'm routinely surprised. I should just get over it, because people in all environments in these market conditions, one of the few things we've seen is an abundance of willingness to dump premium at the drop of a hat. Regardless of what's going on in the macro environment or anywhere else. They really need no incentive, it seems like, at this point.
Oh, I agree 100%. It's just, it's amazing. I think it's the nature of the electronic marketplace. I think it's the nature of a lot of algorithmic trading strategies where they see the news and they smack the bids down, and then the volatility pulls in two handles, and now you have a new level. And I think actually there is some advantage now to kind of wait till the smoke clears from all these guys and looking at a position if you're more interested in on daily entry and exit points. But I was a little surprised by this. I'm not totally. I actually have got a little straddle in the VIX.
Yeah, I was going to say, they keep this up, it might be time for a cheap spec on non-farms, perhaps, if they keep crushing this.
I mean, I kind of backed into it this week, so, we'll see what happens.
I wonder how much of the sell-off, too, is just due to the fact that there might have been a little bit of debate premium built in there, and the fact that no one came off like a drooling idiot or collapsed on stage or rampaged about the gold standard for an hour. Perhaps none of that came to pass.
It feels like, yeah, so... And we'll see. I mean, the thing is you've got 9% realized volatility in the index. It's pretty cheap, right? So it's going to be hard for the index volatility here, the VIX, to kind of maintain this now. That October's starting to go away. It's just in a spot, and now generally volatility comes in as the earnings start to come out. So, things are kind of looking weaker, and I wouldn't be surprised if we saw the volatility smackola tomorrow on a Friday.
And Uncle Mike Tosaw, of course, listeners, as promised, we are joined by the man from the mountains himself, beaming in all the way from St. Charles, Illinois. So first off, welcome to the show, Uncle Mike.
Always happy to be here.
And now that the pleasantries are out of the way, what was catching your eye today? First off, we haven't checked in a while. How was the BBI today?
Oh, BBI was just fine. What I thought was, like, last night, futures moved up during the debate. So apparently the market liked some of the things that they heard during the debate. I don't know, like the S&Ps were, I remember looking at towards the end of the debate, the S&P mini was up around 7 points. So I think that a little bit of today's rally had something to do with the debates or something that happened last night nonetheless.
I guess that plays into the old adage that the market tends to favor the Republicans, despite perhaps what we've seen economically of the past few administrations. But I guess the fact that Romney didn't get annihilated as many people thought he might be on the debate. I only had a chance to watch parts of it, so I don't have a full opinion on the whole thing. But from all the quote-unquote analysis I've been able to read, he more than held his own. And so maybe that perhaps strengthened some of those who tend to lean towards the conservatives when it comes to fiscal matters, regardless, like we said, of any pre-existing track records.
Well, what I thought was interesting is even a lot of Democrats were even saying that Romney did well. And typically, like the standard, after every debate, you talk to the Republican people, oh, Romney clearly won the debate. Or you talk to the Democratic people, oh, Obama clearly won the debate. And, it's never been that clear to me watching all these debates through the years. But this is one where even the Democrats, a lot of them were saying that they thought Romney looked pretty good.
You know what's interesting? I usually tune out most of the campaigning season, but I love the debate part of the season, because all year long these campaigns and these camps have been playing up how their guy is the best thing since sliced bread. My guy is a genius. My guy is this. He's going to solve all the world problems. Debate time rolls around. All of a sudden, my guy is incompetent. My guy can't get a word in edgewise. My guy is an idiot. He's going to lose this debate terribly. Their underselling begins, and it's hilarious to see these people completely shift gears, and these spinmeisters who've been spending the last 6 to 8 months telling you their guy is the greatest things ever is now he's amazed. They're amazed if he can make it on stage without collapsing. So that's probably my favorite part of the season, is just how the spin changes all of a sudden. And oh, my guy is terrible. He should have been wiped. They should have wiped the floor with him. Therefore, the fact that he's still breathing at the end is clearly a victory for him. So
totally. And it's kind of like if you ever if you go to an NFL training camp, rookies always look great in shorts right before they put the pads on, no matter what. And that's just like the old adage. Everyone looks good in shorts. Once they get the debate, you're absolutely right, Mark. The debate is like when you put the pads on, and that's when you get it done and see what's what.
So rookie football players look good in shorts. Is that perhaps a brief glimpse? A brief glimpse into the private life of Uncle Mike Tosaw.
The big 350-pound offensive lineman. Come on now.
Nothing better than that. Go ahead, Rock Lobster.
No, I was saying, I kind of, I don't watch MSNBC very much, but I had to watch it yesterday because after the debate, let's just say some people like to blame other things and make excuses. And oh my God, it was amazing to watch that whole crew at MSNBC just melt down that their fearless leader did not have a great performance. I don't think they really knew what to do.
And Dave, I can hear you champing at the bit to get a word in edgewise. So what was your take on today's action? Anything particularly interesting catching your eye, or perhaps any of the activity we've seen of late in this electoral cycle?
No, I think overall there was some premium selling, and that's pretty much continued. Pretty much the same trends. You had a couple individual names, that are got to push up, like Netflix or these that are independent stories. But the overall market is just, what do you say? Don't short a dull market type of deal. That's pretty much what's going on. I would say so. The volume, of course, is fairly low. It has definitely declined over the last 3 weeks, and today was no different. Even leading into the non-farm payroll number. I was a little surprised myself that the VIX didn't hold up either.
Now, keen-eared listeners will remember a few months back I was going on at length about a big Morningstar advisor conference that was in town here in Chicago and how it was just a wasteland from an options perspective. Well, Morningstar promised me at the end of that show, I said, wait till our ETF show in October. You're going to see a lot more in the way of trading analysis and options type content. So I just came from that conference a few minutes ago. I was there most of the day. I'll probably swing back there tomorrow. And it was interesting to see, and they were right, there was a little bit more of a focus on options. But of course, I think this says volumes to the way they view this product. The sole options panel, which unfortunately started about 10 minutes ago, I had to miss it. But the options panel there was one panel, and it was called Options, Short Sales, and Margin. So essentially, you might as well title that panel, all this crazy crap you never want to touch with a 10-foot pole. So I was dying to go see that panel and see what the turnout was. But I sat in on a few others I sat in on some interesting panels about correlation and a growing correlation. And so I was listening in this panel, and the entire panel was about how things we talked about on the show in the past, about how correlation across asset classes is growing at almost alarming rates, and how if you talked about full diversification 10, 20 years ago, you talked about, 15 to 20 different equities in your portfolio. Now, if you want quote unquote full diversification, you have to have over 40, and all these different graphs and charts pointing to the fact that diversification, the traditional way of doing it, was kind of dead. And they kept talking about different things, and investing overseas, and some guy brought up gold and all how gold was correlated. And finally, towards the end of the session, I had to just stand up because I could take it no more. And I said, looking at all these charts and all these graphs you have here, doesn't this kind of point to the fact that traditional diversification, or full diversification, you used to call it, is essentially dead, or is a fool's errand at this point to chase it 40 plus different equities in your portfolio to have full diversification? And B, doesn't that say that if you're an advisor or a long-only asset manager in this environment and you don't have the skill set to do something simple like manage risk with a put option for an equity, or perhaps pick up a volatility product like a VIX upside call, or even manage futures, whatever the case may be, if you're lacking some derivatives component in your portfolio or the skill set to implement them, aren't you really behind the game? And isn't it essentially impossible to be really diversified in this marketplace without some sort of derivatives component? And of course, I said this in a room full of essentially long-only asset managers and ETF buyers, and so they weren't. I don't know if they were too enthused to hear that comment from me. But and the guy,
well, Mark, you're forgetting that options are risky.
Yeah, and the guy,
maybe we can get him on board finally.
Yeah, and the guys on the panel, they kind of indulged me. They kind of said, well, there's some interesting things, and and they kind of talked about it a little bit. One guy said, well, you can go long and short as a long-only asset manager, and that could offset some of the risk, and you could do that with derivatives. And I wanted to kind of follow up with a bunch of different things, but didn't really seem to be the place, nor did I want to hog the podium for the whole time. But it's just one of those things that just struck me as interesting. And of course, immediately after I asked her that question, and they gave me kind of their kiss-off answers, the moderator turned to the panelists and said, so does that mean that in this greater correlation environment, are we driven towards, what did he call it, more exotic asset classes? I mean, something essentially pejorative, saying, options, God, why would we ever think of those? He really kind of just, I think, like that panel did, where they had him on as short sales and also margin. They kind of lump it all in as this kind of extra stuff that really it just shows that even still, this mainstream name, this mainstream voice for a lot of the public out there, financial advisors, asset managers, the retail public who buys their research, not at all aware, or perhaps not even interested in the true risk management of these types of things. There was a session earlier this morning. I didn't have a chance to make it on volatility and dividends. And I was hoping they would manage, or they would mention some sort of options component in that session. I'm guessing, looking at the names of the people who are on it and where they come from, that the answer is no. But it's just it is still mind-boggling in this day and age, and also I think a little bit disturbing, and kind of just worth ringing that bell again. I've since talked with the Morningstar guys. I talked to them again today. I'm going to try to increase that options exposure and awareness over there at their events and through their content. And obviously that's a big potential opportunity for us here at Insider. But it just goes to show that there's still, in most of these mainstream asset management and mainstream funds, your 401ks, your IRAs, wherever you have a lot of your, quote unquote safe regular money these days, a lot of them are still functionally illiterate on this stuff. And that's a little bit disturbing, I think, because that just goes to show that we really still haven't learned any lessons from 07, 08, 09, and that stuff could easily happen again. The fact that there's not, in this environment, there should be a ton of panels about how you can get away from that correlation, about how you could use things like options to diversify and get away from the 80% correlation. Instead, they had nothing on it. And so I don't understand really the mindset that leads to that. And, we talked about it a while ago, the other conference I was at in New York a few weeks ago, where another buy-side manager stood up and said how if he wants to think about buying a put, he goes to cash. It's just all of this is indicative to really how just outlandish a lot of this stuff still is. And here we are on this panel talking about different things, risk reversals and volatility and VIX, and we're very much preaching to the choir in many respects, whereas there still is an alarming number of people out there in mainstream financial media who really, or financial names in general, who just don't have even the slightest grasp on this stuff. I will say one thing for them. Their lunch speaker was the guy from the Pursuit of Happiness, that guy. And he was kind of interesting, got you a little fired up about, taking care of your life and that kind of stuff. So I came out of lunch very fired up and happy and inspired. So that was good. It kind of offset the rest of the dour note of the conference. And I don't mean to hijack the show or bring it down in any respects. I just had to share that because I just walked out of that a few minutes ago. Of course, I'm going to an even worse pond of scum and villainy tomorrow, which is, of course, the Money Show, which is also in Chicago this week. And if you've ever been to a money show, it is definitely a dubious place. A lot of vipers floating around that area. Unfortunately, I'll be in that midst of them. I'll be doing a talk tomorrow on try to uplift the level of options presentation at these shows, which usually isn't that much. Every once in a while, I go outside the network to do some appearances. Not often. I usually try to restrict them to appearances on the radio network here or on other insider-related outlets. But I'll be doing a talk tomorrow on the top 5 mistakes of options traders. So if you're listening to this tomorrow morning, you can still log in and register for the webinar. I think it'll be free webcast up there. You can find the link on Options Insider or even go to moneyshow.com, search for my name, Longo. You'll be able to find it there. Of course, if you're in Chicago, I'd welcome you there. Welcome to see some Option Block listeners at the Money Show. It would warm the old cockles and make me think that not everyone there is just perhaps a retail zombie waiting for some guru to sell them their latest trading technical analysis program that will trade the markets for them. So there we go. There's my little rant. Anything else catch your guys' eyes in today's activity before we dive into the old odd block?
Hewlett Packard was up 3 cents today.
Yes, that's what I'm talking about.
I sent you guys a blog for OI for that, and my trade worked out okay today, so I'm glad. But yeah, amazing. Like they crushed it yesterday. It opened down. Actually, it closed up 3 cents. So maybe that the stock is $2 below book value now is getting somebody interested in it.
Mm-hmm. To the tune of 3 cents, huh? Okay.
Hey, well, it was down. It was down what, $2.50 yesterday.
Yeah, I know.
It was down 60 cents today at one point, so it finished up on the day. But I'm not saying that's a rousing endorsement, but
it's like some sizable
3 cents. It's 3 cents you didn't have before.
Depends on your delta, but yes.
Yes. Well, I think I'm in a mind of just trying to mindlessly sell puts on this.
Mindlessly selling puts, always a good way to go, I found. Looks like some good volume going up today. They usually do about 58,000 contracts, doing nearly 240,000 contracts today. So,
that thing was trading.
So Hewlett Packard just, lighting up the tape.
With volume.
Yeah, with volume at least. 12.
Also, looking at the swing in oil, have we got to that yet? What's going on with oil? Down $3 a barrel yesterday, up $3 a barrel today. Anybody take a look at that little swing?
Dave, you getting a lot of calls on oil over there on the desk?
Yeah, plenty. Probably just broke through support at 90. Probably went overextended on the downside. I don't see. Oil's one of those you probably want to stay away from right now. I don't have any conviction. I would have thought the airlines and the transports would have sold off a little more if this was a real rally in the oils, but I didn't see that correlation. I like to see that some sort of sell-off in the transports before I put my toe in the water on the long side of oil. But definitely, I tell you what is heating up definitely are the metals. A lot of calls about the metals, whether it be SLV, GLD, a lot of option play. And a lot of retail investors getting back into the metals market from being absent, the last 3-4 months.
Yeah, silver's at a 1 year, almost a 2 year low for implied volatility 90 days out or more.
Mm-hmm.
That's pretty amazing.
Yeah, speaking of other things we've talked about on the show in the past, I know, Andrew, you love the gaming sector, and I believe on the last show we talked about Activision ATVI, one of my favorite little risk reversal candidates. And whenever it gets around to these vol levels into the low 30s and starts getting around these price levels like around 11, which was on the last show, I always like to light up a few bullish risk reversals. It's just been such a routine performer for me over the past few years. It's one of those few kind of stable staple plays you can have in your arsenal. And sure enough, that risk reversal you could have legged in like the 11-12 for at least a dime, 15-cent credit. Now trading about even, so it's doing fairly well out there. Activision, one of these ones we love, vacillating between 11 and 12 all day long, and maybe a little bit high 10s. Makes it for a great range-bound, great options trading name. You could even have just done the credits put spread on the downside and forget the upside, but it worked out either way. You can still get into it for even money, but it's not as attractive now with vol. Let's see, where are we looking now on these ACH 11 puts? Well, the vol still, hovering close to 30, about 28, 29, so it hasn't come off too much on that strike, but still interesting how that name has been so reliable of late. I know you were looking at getting into it, Andrew. Did you ever do it, or were you content with your Zynga?
I haven't yet. I just got other stuff on I'm looking at a couple other risk reversal stocks. I only can have so many at one time, but I think it's a good play. It's a good because it's kind of a reliable stock. So, I mean, that's what you want for it.
Yeah, 4 has been pretty boring of late. A lot of my other staples that I like to go to have been kind of not too attractive.
I just wanted some stocks with some more upside. Like, if we can get past this, Spain had a good bond auction today, which I think was probably the biggest driver of the vol coming in. Now that, basically the ECB says they're going to buy bonds, then everybody else steps into the market and buys them. Then the ECB doesn't have to spend their money, and Mario gets what he wants. They just got to make sure that those countries kind of toe the line. But it could work like that, right? So, I mean, the Spanish are playing that game. But if we could actually get some, that's why I'm looking for like risk reversals, but with stocks that really have some pretty good upside, upside potential. Like some of these little junky $4, $5, $6 stocks, that could grow to become. I like that risk reversal with a small, with basically a credit or even, and then with some decent upside on them. So we're getting almost to that point again where the market could actually start going up to some new levels if and only if the Spanish can get their act together.
What we need is that iPad mini to come out and goose the market again. Here we go. Apple off to 750. Uncle Mike Tosaw in no BBI day in a complete panic, printing money left and right.
There we go.
Anything else before we dive into the old odd block? I'm just stalling because I've been out all day, so I haven't had a chance to dive into the odd block myself. So I'm giving you a chance to stall for me. Last chance. Going once. Going twice. Okay. Then with that, we shall dive right into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and welcome to the Odd Block. We're going to kick things off today with a name that is kind of the polar opposite of one of Uncle Mike's favorites, which is Dollar General. We're not talking about Dollar General today. We're talking about Sachs. So a little bit of the other side.
Same thing,
yeah,
right?
Half a dozen one. They think you buy stuff for about $1.50 at Sachs versus $1 at Dollar General.
Yeah, they have a 50% markup there,
yes,
huh?
Exactly. And, of course, listeners, if you'd like to follow along and play the home game, then by all means, surf on over to theoptionsinsider.com. You can click on the Unusual Activity tab. You can see all of these entries that I'm reading along and much more laid out there for you. We're going to kick things off here with Sachs. Like I said, ticker symbol SKS. They closed at $10.61 today, up about 3% or 30 cents on the day. This is the name that's saw some fairly decent upside post earnings looks like about a little over a month and a half ago. They were trading almost $12. They've since come off substantially, trading in this 10.5 range for a while. But it looks like someone feels that $12 range wasn't entirely overdone and thinks they're going to hit it. In fact, they're going to hit it again relatively soon because we saw someone piling into some very near-term upside here. Specifically, the ACH 11 calls. We saw right after the opening bell, the ACH 11s were lit up about 2,200 times, lifting the offer for 15 cents. That same guy, I'm assuming, just came back a few seconds later and picked up another about 1,200, bringing his total to about 4,000 or close to on the day, and total on the strike about 6,500 contracts. I'm guessing he came back a third time after we wrote this up. These calls closed out about 20 at 25 cents, so he's obviously bid up the vol on that strike. He's already paying about a 42% vol on that strike, which is about substantially higher than what we've seen of 38 and 23% in recent months on that same strike level. And so a lot of upside. Of course, the open interest only about 1,200 contracts on that strike, so looks like this is all essentially opening paper here. Someone thinking that there's a near-term bounce to be had in size high-end retail as Sachs lighting up the old tape. Mike or Andrew or Dave, you guys watch or get any calls on Sachs today?
Not on my end. No,
I didn't get any out here.
No, just a bunch of empty sacks for me. No sacks. No sacks.
Like you said, it was one guy.
Oh, that kind of Sachs.
That totally sacks.
Didn't they get eliminated from the playoffs, the Chicago Sachs? Oh, the Sox.
Yes, and so did Boston, thank you. That's from the way.
Oh, Boston getting eliminated? Dude, I think they only won like 8 games this year. I don't even know how many games they won. That's a sport. I don't watch sports.
This is not the sports block. That's later in the show where we hit on all that stuff and some of the trading aspects of betting on teams, but that's for another show perhaps. But next up on the old odd block, we're going to hit looks like a recurring theme here today. Upside calls being the de rigueur trade. We saw Dell lighting up the tape with some upside as well. Dell not exactly a darling of the tech industry of late. This name really hasn't had too much positive news to bounce it or buoy it of late. Yes, this name hasn't had too much in the way of really positive developments, but today looks like someone came in. This name, of course, closing at about $9.47. Typically doing about 24,000 contracts of late, which is actually some sizable volume for Dell, given the fact that this name is kind of languished of late. And today they did about the same amount. But what was interesting is a bunch of that volume was similar to the story we saw on Sachs, was piling into some a little bit longer term upside here. In this case, the November 10 calls, which are just 50 cents out of the money or so right now, lifting the offer on those for prices in 20 to 22 cent range. We saw about 5,300 going up on the day today. Now, there is some open interest, about 4,500 contracts, but it looks like all of this was opening buys for the most part. Doesn't look like this was closing buys. This is another one. This guy paying a little bit of a premium on the vol side with paying about a 33 implied vol for the bulk of these options when these strikes have been trading around 29%. Not too bad, not too much of a premium given the fact that he bid up and bought quite a substantial amount of them. It's kind of to be expected that he's going to bid up the vol a little bit. This is not an earnings play because these options expire a couple of days before earnings, actually. So this is not an earnings spec. This is a pure Dell is going to rally hard to the upside. Maybe this guy is looking at what you've been doing in Hewlett-Packard there, Andrew, and thinking Dell's due for another bounce as well.
Yes, I've done nothing in Hewlett-Packard except for today. So that was my. I was just surprised that it actually started to go back up. I'm like,
this is probably one of your option pit mentees. He heard what you were saying about Hewlett, and he said, I want to do some size in another name that's kind of somewhat similar.
Well,
how about
you
Dell?
Think about it. Actually, Mark had a good idea. It's like, look at Hewlett as an investment. Buy the 2014 calls for like $2.50. Where's the stock going to go? It's already trading at 7 times earnings on the diminished earnings of next year. So it's not like it's an expensive stock. And, you just sit on it for a year and a half, but instead of buying those calls, instead of buying, if you're going to buy 1,000 shares of stock, it's $18,000. You can buy a lot of options for $18,000 and have tremendous upside leverage. So,
that's true.
I don't know. Just a thought.
We typically counsel we counsel a lot of stock replacement on this show, but you can even use it for names that are relatively cheap. Like the $14 stock doesn't have to be a $700 Apple type name to really kind of use those types of strategies. And you're right, of course, Hewlett-Packard is kind of a weird beast. They've had such a troubled history of late, and they bought Palm. And they spent all this money on it, then completely dismantled it, and it was just one of these weird companies. They kind of like Yahoo. They can't seem to find their footing. They don't really seem to know what they are anymore. And they're in a commodity business like PCs and desktops, not getting any margins there. They had that cool touchpad with some cool OS, but they priced it wrong. They never promoted it, and they kind of just withered on the vine. They bought the Palm stuff. That stuff's all kind of withered and gone or shut down. Those guys have all left to other companies. So yeah, I don't know what the near-term upside is for HP unless they're going to find some way.
They're just gonna right the ship. They're not gonna buy anything else. They're just gonna, it's weird. A Hewlett-Packard tends to go through this like every 10 years, where they have to kind of reinvent themselves a little bit, straighten their act out, get back together again, and then it kind of has a long rally into like the mid 60s. And then they screw it all up again, and it craps out again to like.
Well, hopefully they won't follow that same trajectory of the HP Compaq deal, which is probably one of the worst deals. Even at the time, it made no sense to me. I still have yet to hear an argument for why that two almost exactly the same identical companies made sense merging with so much overlap. But yeah, it was a weird one to say the least. But yeah, HP. I guess if you are bullish, it's certainly better to buy the options than it is to gobble up a $14 stock that's going to head to zero. A lot of better ways to do that, I think. So interesting stuff. And I think with that, with these two size upside buys in Sachs and Dell, we're going to close out the old odd block and dive right into the Xpress Block.
The Xpress Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and welcome to the old Xpress Block. This is, of course, where the boys over at OX take the reins and I get to rest my tired vocal cords. And today we're going to throw to the wolves good old Dave. It's his first appearance on the show, and we're going to let him have at it in the Xpress Block and see how he fares. So, Dave, what do you have in store for us today, sir?
Well, just a few little notes. Of course, the volume is a little bit lower than normal. Nothing out of the ordinary, but we did see a couple of large trades. There was one service. They did a Russell spread. They were selling the call spread 790, 800. They actually got 4,000 of them off at 75. We had another open order for about 2,000 that was not filled. So that was a pretty good size order. Somebody taking definitely a definite position in that, thinking the upside's pretty much limited. And what else did we have? We had some also some large put selling. We had about 1,200 contracts on the SPY. That was the call side. That was the 148, 150s. They were selling the SPYs. And I apologize. The 800, 870s was a put spread. 4,000 times they got off at 75 cents. And like I said, we had another open order that was not filled for about 2,000 contracts. So, and who knows what else was out there.
Good thing you're not a clerk on the floor these days, Dave. Those kind of puts versus calls errors can be costly.
Yeah, that would be kind of ugly.
You sure you weren't at Merrill a couple of weeks ago when they were processing all those SPY dividends? Was that you? Were you hanging out over there?
Ouch! Let's not talk about those. that took a while to clean up. That was not pretty, and it happens every quarter too. Same thing.
Yeah, it's crazy. People seem to forget that train is coming every quarter. They just forget that there's this dividend.
Yeah, I keep telling everybody, reminding them whenever they have a position, anytime anybody trades the SPY or is short the calls, always mention it. Have to try to get it out to your people, whoever you speak to too, because it seems to be an ongoing problem. But anyway, so that was a couple trades of note. Like I said, really what is heating up is the metals market. We see a lot of activity now, renewed interest. I know we had that decent rally in silver, and it kind of petered out. But again, now it looks like it was consolidating, and it's definitely trying to push upward. And I think the retail investor is seeing that, and definitely jumping on that trade right now. As far as anything else, the grains were kind of lackluster. After that limit up move on Friday with the grain stock report, didn't see any real follow through on it. Which typically would definitely signal like definitely a bullish market, a renewed bull market. But, the beans have kind of been languishing. They did bounce off a moving average today, but no big deal. And corn really hasn't gone anywhere ever since that Friday limit up.
Aside from Friday, I had an interesting chat with someone the other day, and we were talking about how everyone's searching for vol and searching for activity in the markets these days, and how realized vol in the S&P and NASDAQ is pretty anemic. The VIX is low. And he was talking about corn. He's a commodity guy. And he says few people seem to realize that corn's moving on average 5% a day. And you're talking about places where there's actual legit realized vol, except for perhaps this past week. Corn is this kind of, that shows why it's been so popular over the past year. There's still movement, there's still activity, there's actual vol in corn. And so it's a 5% a day. You can imagine if the S&Ps were swinging 5% a day routinely. I mean, I know we had that period last year, August through October, where we were kind of pushing that on a few days, but it wasn't a regular basis. Imagine 5% a day across the board in the S&Ps. What sort of how your phone would be ringing off the hook there at OX there, Dave?
Oh, yeah. Well, definitely a lot of option sellers in the grain market on both sides of puts and the calls. Definitely. That's the preferred strategy. I think
that's why they've kind of been holding out, that some of this, 5% a day move has shaken a lot of these premium sellers out for a little bit, and they're kind of keeping their powder dry for a little while and trying to recoup some of those losses.
No, I have not seen any huge bad positions, because there are times where you are able to get out. You're not getting caught in those 2-3 day upswings of 30-40 cent moves. So nobody's getting crushed, I should say that. So, that's good. No massive liquidations or forced, covering. I'm sure to some degree, but nothing that would really signal something for the market, because you had chances to get in and out if you were wrong. So that's one good thing if you're keeping up with it. Right?
Yeah, that's unusual for corn of late. Seems to have been just limit up and you're kind of locked and you're screwed. But if you have to have had some opportunities lately to get in and out, then that makes it far more viable, even for those premium sellers, to kind of get off the table when it's moving against them.
Well, I definitely thought we were going to get something on Sunday evening or Monday, some follow through, but really it didn't materialize. So I don't know if there's much of a bull market there for now, but definitely a good trading market if you're not taking advantage of it. And of course, they have good decent spreads on the options on those also. But anyways, what else is of note? We had some biotech news. This SRPT, I think that was up about $30 yesterday. Closed at around $15 prior day. Was up to like $45. Moved up $30 in the day. You might want to take a look at that. I'm
pulling up this chart right now. This is pretty crazy. Sarepta Therapeutics.
Mm-hmm. And if you look at the option volume, it seems to be something noteworthy. If you have a play on it, you could definitely get I did do a 40-45 call spread today. I sold for $2 myself. We'll see what transpires with that one. But again, I think we touched upon HPQ. Unfortunately, to me, it looks a little bit of dead money. MU, all the chip stocks back that up. Anything PC related. Netflix had a really nice day. A lot of people were playing Netflix options. They had a buy recommendation on Citigroup, or they reiterated a buy. So the stock set a low. It was 58. I think it closed at around 67 today. So a 2-day move, and it was broken up into 2 days, $4 and $4 basically, both of these days. And of course, we have the non-farm payrolls coming out tomorrow morning. So we're all pretty much waiting for that. And we'll see what happens. But hopefully we get a little bit more volatility.
Well, thank you for that, Dave. I think you fared fairly well here in your inaugural Xpress Block segment. So the guys can't give you...
He's the man.
Yeah, the guys can't give you too hard of a time back at the old HQ.
Well, they will.
If they do, just send them to me. I'll set them straight for you.
No, they'll be talking about my shirt or my shoes or who knows what. It's... anything is open.
No rest for the wicked. Well,
the gloves are off around here.
Thank you for that, Dave. And now we're going to roll right into the strategy block.
The strategy block.
All right, and welcome to the Strategy Block. And Uncle Mike, it's been a while since we've had you strategize for us here on the old show. So I think I'm very excited, I'm sure the listeners are too, to hear what you've been cooking up over there in your lab in St. Charles, Illinois. So by all means, sir, unleash it upon us.
It shall be unleashed! Anyway, today I kind of want to expand on what you were talking about a little bit today, Mark, with just being at the big conference and diversification and what a lot of this means. I'm going to tell you guys something pretty shocking right now. Most actively managed mutual funds don't beat the S&P 500 over a longer period of time.
Heresy, sir. I don't believe you.
Yeah, I know. Isn't that just a shocking thing?
Holy gosh, really?
I know. It's... I'm surprised that you guys aren't having heart failure right now hearing such a scary statistic. But I kind of want to go through the why of it and ways with which to strategize to where there's times that, to give you an idea of it, and the money that I manage personally for clients, I would say less than 0.5% of it is actually in a mutual fund. And there are situations where I think they can make sense, but to me, it's just kind of a unique situation. Now, first off, why is that over a longer period of time, most mutual funds don't beat the S&P 500? Now, granted, you'll see things like, we beat our Lipper averages 3 of the last 7 years, or you'll see statistics like that plenty of times. But over a 30-year period, most of these funds have not done it. Now, the reason that is not, it's not necessarily that the mutual funds are dumb and that the fund managers are idiots or anything like that per se. It's just that the way with which they are regulated, they're not allowed to have more than 5% of their holdings within one specific equity. Now, with that being said, you have to have an understanding of the fact that if like Fidelity Magellan were to put even 4% of their holdings into one equity, they're not able to do that without causing the market to move in one way, shape, or form. So with that, the way with which the market is these days, especially the way that Mark's describing it in terms of the diversification issues that we're having right now, a lot of the fund managers are forced to be basically overpriced index funds. Now, with that, let's expand that a little bit more. Let's say that I'm a fund manager and I'm getting hundreds of thousands of dollars in bonus just to beat the S&P by 1/3%, or even just by 0.1%. That way, I can go on the fund can go on the commercials and say, we beat the index this year. That's going to be a huge motivation for him. If all of a sudden that fund is beating the S&P by 15% in a year, it's going to be a red flag to the mutual fund itself because of the fact that, well, wait a second, are you guys really diversified? What are you guys doing? Are you guys holding your objectives? How come you guys are 15% ahead of the market and every other fund is only maybe 1 or 2% ahead of the market? So it's almost as if it's a red flag for doing something better for the client because it's going to be perceived as a greater risk. So the point of my conversation on all of this is the mutual funds are really not in a position to where it's going to offer you a lot more diversification than an index fund typically. Now, there's exceptions to the rule. I'm a fan of the PIMCO Total Return Bond Fund with Bill Gross. I think that's, if you are going to invest in bonds, I mean, he's obviously has a proven track record for many, many years, but that's kind of the exception and not the norm. Where I use mutual funds is if, let's say, a client has to do, let's say it makes sense for the client to do a 529 plan. And with that, I have one client with which we have a 529 plan that's not under my management, but we hedge it with options in another area. So there are certain situations with which it makes sense, but in my experience and with my clients, it's definitely not the norm, to say the least. Now, with that, that leads us to the question, what about an ETF? Why would you invest in a mutual fund when you can have an ETF? Well, quite frankly, an index mutual fund and an ETF are, in a lot of cases, the same thing. The Vanguard 500 index fund and SPY, the ETF, are going to have almost an identical performance and a very similar fee structure. So with it, if an index mutual fund and an ETF are very similar in longer term performance, the advantage of the ETF, of course, is that you can trade options on it. It's traded more efficiently in that you can get into it, get out of it during the market day. You don't have to wait for an end of the day quote. And that's why for my clients, I prefer ETFs typically to mutual funds. Once again, not against mutual funds as a whole, but it has to be a specific situation before I'd ever put any of my client money in it or any of my personal money in it. And like I said, probably 0.5% of our overall assets my overall assets under management is actually in a mutual fund. So that is the strategy for the day.
Thank you for that, Uncle Mike. Good to have you back in the old strategy block. And, I was lambasting the funds a little bit earlier in the ETFs, and there certainly is some points to be made there on that fact that they don't really have the skill sets. But you're right, there are a lot of restricted covenants and other things that keep them from perhaps doing some of the things they would want to do, in addition to the lack of education, which is why I think, obviously we're preaching to the choir on this show, but we still tend to espouse the fact that, if you have the wherewithal and a little bit of the interest and spend a little bit of time, get interested in your financial well-being, go find an advisor or an asset manager who you can work with so you can come to them with your own self-directive initiatives and say, hey, I like this, I like that, I like that. And then instead of going to some wirehouse guy who's going to say, what's your age, what's your risk tolerance, okay, here you are, 70-30 stock bonds, you're done. And then, of course, the guy you pick one of the reasons why we like having you guys from KYO on the show is you're one of the few houses out there that can bring something else to the table in terms of risk management expertise. And that's what you really want to pay that guy for.
They do stuff.
Yeah, exactly. They do stuff. If you're paying all this money to a financial advisor, and it's not cheap, you're giving them a percentage of your assets or whatever the case may be.
Oh, it's cheap. Come on.
But yeah, I'm just saying, if
it's inexpensive.
If certain ones are more inexpensive than others from a value perspective, Okay. And if you're going to do that, then you really want to pay for someone who's bringing something to the table. And if he's just putting you in the spreadsheet and saying 60-40, 60-30-10, he's not really doing anything for you. If he's actually actively implementing protection in your portfolio, he's adding, volatility as an asset class to your portfolio, he's actively mitigating your risk, that's worth paying for, because that's a skill set that is valuable, that has a clear benefit to you as the client. So that's why we've always kind of espoused that philosophy here on this show. But of course, you're free to go buy the Vanguard fund as well if that's what you think. But I'm guessing the people who do that are not listening to this show.
That's my guess as well.
All right, thank you for that, Uncle Mike. And now we're going to dive right into Around the Block.
Around the Block.
All right, and welcome to Around the Block. This is, of course, where we discuss what's on our collective radar going into the weekend. And as we talked about earlier on the show, there's really one thing I think we're all looking at, aside from the macro issues like Europe and everything else like that, and of course the impending election. The more immediate near-term event is, of course, non-farms tomorrow, and apparently, as we discussed at the top of the show, the market is kind of shrugging it off because they were dumping risk and dumping premium going into the close today, which is interesting given the fact that this has had the potential in the past to be a bit of a market mover, and certainly going into the weekend, not usually a time when you want to dump going right into such a big potential number. But still, nonetheless, that's what we saw. So I'm guessing Andrew, Mike, and Dave, that's pretty much what you have on your sites for the next day going into the weekend as non-farms, correct?
See.
Yes.
Yep.
Yes, sir.
Just a little VIX back spread, and that's it.
Yeah, aside from that, it is interesting. They were talking about, like I said today at this panel, about correlation, and they were getting into some of the reasons why this correlation has increased across the board. And one of the things they were pointing to is, something else we've been talking about on this show forever, is that just the increasing sway of global macro events across, all the different, impacting everyone almost equally. And so that's really tended to drive things like small caps and large caps are starting to correlate much more, different asset classes, international, domestic. The correlation is just absurd. They're even saying in a lot of large cap stocks and even small caps, 50% correlation across the board. I mean, it's just getting insane. So in this kind of environment, I think it makes a show like this even more relevant, because if you're not adding at least a few options here or there to your portfolio, then you're kind of missing the boat, as we've been saying quite a bit. So yeah, I think for at least for us on the panel here, most of us keeping our powder dry going into tomorrow's number. The rest of the market, not really so much. They're blasting away. Anything else really catching your eye? Any good earnings coming up, Dave? Anything else that clients have been pestering you about over the last few days?
No, it looks like everything is going to start coming out. All the big boys are coming out after the October expiration. So look to the end of the month to start seeing any interesting earnings plays.
Yeah, I can't believe, speaking of earnings, I can't believe we're talking about Apple earnings again. It feels like we just got through with this, and they're already announcing the 25th.
Wait, tomorrow?
It's
25th.
No, they're November 8th, Uncle Mike, so you got some time.
Oh, November 8th. Okay, good.
We just did this whole song and dance. It feels like a week ago, and we're already prepping for another Apple earnings cycle. It just seems to me to be insane. But yes, the 25th for Apple earnings, so Uncle Mike will have a busy rest of the month. You can sleep until the 24th or so. Then I think you'll be called to do some stuff.
Oh, I'm gonna have to do some stuff sooner than that, I'm afraid.
Yeah, given the run-up we've seen lately, it probably will see. Maybe we will see a bit of a turnaround here, pushing back towards the 700 club, as we've seen previous cycles.
No, that might be out of it by then.
Yeah, you're right. They will let you out if it got up to 700 again. So that won't happen. It'll go to 689 half and sit, and you'll never get out, Uncle Mike.
They let him out of Apple. That's how he works for his money. They're going to make him stay in it forever.
Yes.
He's going to have to roll stuff till he's an old
you will
man.
You'll be Michael Corleone from The Godfather. They will keep pulling you back in.
I really don't have a problem with that.
Yeah, and I guess if it goes to 1,000, there are worse problems to have.
I don't mind making a living telling people, hey, we're up another 200 points, and sorry we couldn't capture all of that because of the hedges. I really don't mind doing that.
Yes, there are definitely worse calls to have. All right. I guess non-farms is pretty much it. So with that, we're going to close up the old Around the Block segment. And that's also going to do it for this episode of the Option Block. But before we go, I, of course, want to check in with all of my cohorts here on the panel and see what's up with them. Quick reminder, if you are going to be in Chicago tomorrow, or if you are going to be online tomorrow around, I think, 10:30 or so Central Time, tune into the webcast where we'll be talking about all kinds of fun tips and tricks for options, including your top 5 mistakes of options traders and how to avoid them. One of my favorite little pet projects that I dig out every now and then, and it usually has a pretty strong response. So check that out. You can find the link on Options Insider, or just go over to Money Show and find the link there. Just search for my name, LONGO. And Dave, since this is your first show, why don't I let you kick off the rest of the round of plugs? What's coming up in the land of OX?
LONGO, and Longo was his name. Oh, sorry.
There you go. Couldn't resist, that sorry. One. I appreciate it. No, hopefully we'll be checking in Monday or next Thursday, so we could have a little bit more for you. I'll definitely put a little bit more together.
All right, thank you for that, Dave. And then, of course, Uncle Mike Tosaw, how did the webinar train go this week? We actually had a new record attendance. That Sebastian guy, he is a bit of a big deal now. We had, I think, 234 people in attendance for the Sebastian webinar the other night, and we were excited. It was a great webinar. It's a lot of work for me because I get all this positive feedback in my emails. So
you got to do more stuff.
I got to do more stuff. So, but yeah, it was a great webinar, and we're excited about next week. We're going to have Price Headley coming on Tuesday night, and he said he could come on the show on Monday, so we're excited to have Price.
There you go. Kick open the old interview block again. We had dust that one off. We haven't used that in a while, but it'll be fun to have some interesting new voices on the old show. And last but certainly not least, Mr. Rock Lobster, what is coming up in the land of the pit?
I am going to be getting on an airplane and leaving my lobster trap to go to New York this weekend. For T3, we'll be doing a little guest speak on managing an option position by looking at realized volatility, a highly exciting topic for me. And yeah, Mark had a good time at the KYO webinar this week. So that's what we have, at least just in the near term, for Option Pit. Also know we'll be relaunching a couple of products, within a month or so. So, things are moving along. That's all I can say. Things are moving along.
Enjoy yourself in the old Big Apple. I just came back. Have a nice, tasty pretzel. And there's a little empanada booth in Times Square now, which is just fantastic. So I encourage you to.
That's where I'm going to be. I'm going to be in Times Square at the Marriott Marquis.
Yeah, it seems like every event in New York these days is at the Marriott Marquis, which is just the place. So yes, you will be right across in the empanada stand. Tell them I said hi. All right, and with that, we're going to close out the old option block for today. But before we go, we of course want to thank all of you out there for downloading and streaming and subscribing to this show and making it such a success. And we'll see you next week right here on the old Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.